Hi there, and welcome to lesson number 2 from the Modeliks Financial Planning Masterclass. Today we talk about revenue forecasting. Before we go into the methods for revenue forecasting, let's talk about what is revenue. Revenue is the amount of money a company generates from the sale of its goods and services. And it's that simple. Now, there are 5 main revenue forecasting methods that you should be using when forecasting your revenue. Method number 1 is quantity times price. Basically, it means the number of units you're going to sell multiplied by the price at which for each unit. Method number 2, capacity utilization. This revenue method is useful for companies where their revenue is constrained by the capacity that their company can generate. And we'll go into more detail about each one of these revenue models. Model number 3, market share forecasting model. Number 4, competitor benchmark revenue model. And number 5 is a driver-based revenue forecasting model. So let's deep dive into each one of them separately. Quantity times price. This is the most common revenue model, which is suitable for most businesses. You would calculate your revenue by multiplying the number of units you're going to sell times the price per unit. Revenue model number 2, capacity utilization. As I mentioned, this is best for companies where their revenue potential is constrained by the capacity of their business. A good example is a hotel. A hotel with 10 rooms cannot generate an infinite amount of revenue. The revenue the hotel can generate is constrained by the total number of rooms which they have and the number of days in which the hotel is open. So in order to calculate your revenue, you would still use, for a hotel, for example, you would still use the number of units or the number of rooms rented times the price per room. But in order to come to the number of rooms that you sell, you would take into consideration the capacity that you have, meaning 10 number of rooms multiplied by the number of days which you're working, multiplied by the utilization rate of those rooms. This revenue model is also useful for restaurants because the revenue is constrained by the number of tables each restaurant has. It's great for production businesses where number of products you can produce, it's constrained by the production line and so forth. Revenue model number 3 is the market share forecasting model. And here you would calculate your total revenue based on the total market size for your products and the market share which you expect to capture with your business. Now, the market share revenue model, although it's quite often used, it should not be used as a primary forecasting model. It should be used for sense checking your revenue projections only, while using a different method for forecasting. Method number 4, competitor benchmarks. Let's assume you're a new restaurant again, and you don't have past data. You're not sure how much revenue you can generate. What you can do in order to forecast your revenue for your new restaurant is to compare how much revenue is a similar restaurant in your area generating. So let's say if there is a similar restaurant with 20 tables which generates $1 million of revenue per year, you would say, well, $1 million is my revenue target based on the competitor benchmark, and then you would adjust that number based on the specifics of your business. So if your competitor had 20 tables and your restaurant has 10 tables, that means that you can probably generate half of the revenue that your competitor generates. So if they have 1 million revenue for 20 tables, your projection can be $500,000 for 10 tables, adjusting your competitor revenues based on the specifics of your business. Again, the competitor benchmarks revenue model should not be your primary forecasting model. You should be using it as a sense checking model for your forecast. And finally, revenue model number 5 is a driver-based forecasting model. And if you want to have a professionally done financial plan, you should always try to forecast your revenue based on the operating drivers which have impact, which drive your revenue. Let me give you an example. Let's say you're a consulting business where your revenue will be calculated by taking the number of customers that you have multiplied by the total price that you charge each customer. Now, to calculate the number of customers, you should break it down into the operating drivers that you can control, measure, and improve over time in order to be able to manage your business better. So your total number of customers could be equal to the number of leads that you generate for your business, multiplied by the conversion rate from a lead into a customer. And then now your number of leads can be calculated separately as the total visitors that come to your website times the conversion rate from a visitor into a lead. The reason why it is important to build such a driver-based revenue forecast is because most of these drivers now are drivers which you can influence, measure, and improve. So the number of visitors is something that you can easily increase by increasing marketing spend. The conversion rate from a visitor into a lead, you can improve by changing your website and your landing page so that it converts visitors better into leads. Then your conversion rate from lead into a customer is something that you can control and improve by training your sales team better and getting them to become better at converting leads into customers. So a proper financial plan should have a revenue forecast based on the drivers, the operating drivers, which you can control and improve over time. Now, once you have defined the revenue model that you want to use, it's time to define the assumptions that will go into your revenue calculation. So usually there will be three methods which you can use to define your assumptions. Number one is always the go-to place for whenever you start forecasting, and this is your historical financial data, financial performance adjusted for your growth plans. If your company has been operational for a while, you have your assumptions already in there, and you just have to adjust them for your growth plans. Method number two, when defining assumption, is to look at competitor and market benchmarks. See how your competitors are doing, and based on their performance, you can define the assumptions for your financial model. And method number three, when defining assumptions, would be to go on a driver level. To define the assumptions on a driver level. So if your revenue model is defined in detail on a driver level, then you should define your assumptions at those drivers using market and competitor benchmarks as well. So those are the three ways that you can define assumptions and the value of those assumptions: historical data, competitor benchmarks, and driver level benchmarks. Now, let's jump into Modeliks and see how forecasting revenue is done in Modeliks and how quickly it actually can be done. This is Modeliks. Let's create a revenue stream in Modeliks. In the Revenue tab here, click the Add Revenue Stream button. First, we need to name the revenue stream. Let's say we sell bike sales. Then we have to define the revenue type calculation. There are four main revenue type calculations available in Modeliks. Product sales is best for selling tangible products. You will calculate the revenue by multiplying the number of products you sell times the price per product. Service revenue is best suited for service type of business, like consultants, where they charge their clients based on the number of billable hours that they sell times the price per billable hour. Subscription revenue stream is best for SaaS companies, where they charge their clients on a regular subscription basis. And revenue only is a revenue stream best used in case none of the other revenue streams work, where you don't provide any additional assumptions behind the revenue, you just put in a number. Let's say you want to generate $10,000 per month. Now, since we are selling bikes, we are going to use the product sales revenue type. Click Next. Now we need to define the number of bikes we're going to sell, or the unit sales, and the unit price, or the price per bike. Let's say that we expect to sell 100 bikes the first month, 120 bikes the second month, 150 the third month, and so on. We can copy paste numbers, or if we don't expect this number to change over time, we just click this arrow here and we paste the value all the way to the end. Now that we define the number of bikes that we're going to sell, we click Next and we define the unit prices, or the price per bike. Let's say that we expect each bike to sell for $500 on average, and we don't expect that number to change over time. That's it. We have defined the unit sales, the number of bikes, and the unit price is the price per bike. Click Save and Close. And now we have our revenue from bike sales calculated based on the unit sales and the unit prices. Now, I mentioned before that in order to create a professional revenue forecast, you should always try to base your revenue on the drivers that you can control, measure, and influence that influence that specific revenue stream. So let's go through an example for our bike sales revenue stream. I'm going to click Edit. And now I'm going to go to the unit sales, or the bikes that I expect to sell. And I'm going to say I don't want to actually input the number of bikes I'm going to sell. I want to calculate the number of bikes based on two drivers which influence the number of bikes I can sell. In order to do that in Modeliks, you click this button here called Set Formula. And now you need to define the drivers that will influence the number of bikes you sell. In this case, this will be two drivers. Click Add Driver, Create New. And the first driver will be number of visitors. In case we are selling bikes online, this could be the number of visitors to our website. The data type is number of visitors, and the category is sum. Click Create. The second driver that influences the number of bikes I sell is going to be the conversion rate from a visitor to customer. This is a percentage type, and it's an average category. I click Create. Now that I have defined the two drivers that will influence the number of bikes I sell or the unit sales, I will set the formula for calculating the number of bikes I'm going to sell. And that will be equal to the number of visitors multiplied by the conversion rate from a visitor into a customer. Click Set Formula. Now, the unit sales or the number of bikes is not an input field anymore. Now it is calculated based on the number of visitors and the conversion rate. Let's say we expect to have about 10,000 visitors per month on our website. And this number will not change over time. And then the conversion rate from a visitor into a customer will be 5%. Now that we have defined these two drivers, we click Save and Close. And our bike sales has been calculated, again, by the number of units or the number of bikes I'm going to sell, which is dependent on the number of visitors to my website and the conversion rate from a visitor into a customer multiplied by the unit price. The reason why it's important to calculate the unit sales based on their drivers is because you can influence these drivers, you can measure them, and you can improve them over time. The number of visitors, you can easily increase the number of visitors by increasing revenue, increasing marketing spend to bring more visitors to your website. And you can increase your conversion rate by optimizing your website to convert better the number of visitors that come into customers. So that's it. Creating a driver-based revenue forecast within Modeliks is as simple as that. Now that we are done with our revenue forecast, there's one last step before we're done with it, really. We should be sense checking our revenue forecast once we are done with them. There are four main ways to sense check your revenue forecast. Number one is to compare your revenues and revenue assumptions and revenue growth versus your historical data about your business, if your company has been operational for a while. Number two, you should benchmark your revenue assumptions with market benchmarks and competitor benchmarks. Number three, you should check for any capacity constraints that you might have not taken into consideration. Again, just to remind you, if your business is a business that can constrain your revenue generation based on the total capacity that your business has, like a hotel, number of hotel rooms or number of tables in a restaurant, you should always check and sense check that your capacity doesn't constrain your revenue and you have overestimated your revenues. And number four, you should always benchmark your revenue assumptions on a driver level versus market and competitor data and versus historical performance of your own business. Once you've gone through these four sense checking methods, you should have defensible and easily explainable revenue forecasts where anyone that you present to can buy into. Finally, the last subject is some questions that investors might ask you if you're presenting your revenue forecast to investors. Number one question that you will get: what is your revenue model? Number two, what are the bases for your assumptions? Number three, how does your assumptions compare versus similar benchmarks and competitors in your business? And number four, what is the market share that you expect to have in 5 years? If you follow the steps that I've explained during this course, you will be able to easily explain the revenue model, the basis for your assumptions, defend your assumptions versus benchmarks, and sense check them against the market share in 5 years that you would have in order to make sure that your revenue benchmarks make sense to investors. That's it. I hope this was helpful when it comes to revenue forecasting. Stick around. The next subject will be forecasting cost of goods sold. See you around.